Welcome to those just joining us. This is Jumpstart Germantown's weekly JUMPinar, and just give us a few minutes here to let others join in, and we'll get started in a few. Hello to everybody just joining in. Just give us a few minutes, and we'll get started once some more people get in. All right, we're going to give it just one more minute to let others join in, and then we'll get started with tonight's JUMPinar. Thanks to everybody for hopping on, if you have so far. Okay, so it looks like we'd have just over 45 or 40 people in here. So thank you to everybody for joining in. And as I'm scrolling through the list of names here, I'm seeing some familiar ones that I've emailed back and forth with. So welcome everybody, and thanks for joining us. This is our weekly Jumpstart Germantown JUMPinar, which is a weekly webinar series in which we cover special topics in real estate. And they sort of serve as supplementary courses to our official training program. And we cover all sorts of things, but tonight we're going to be focused on a particularly big part of the whole, lending process for real estate projects. And we're going to go over proformas, and we're calling this our Proforma 101 case. And we have Bryant Riley with us from Jumpstart Tioga, as well as his current position, which I'll introduce in just a minute. But thanks so much, Bryant, for joining us. And before we hand it over to you, I just want to let everybody know that the Jumpstart Germantown and Jumpstart Philly loan programs are lending. And if you go to our website, you can find all of our terms, as well as the lending boundaries and the application process and everything you need to know. So I'll put those links in the chat in case anybody is unfamiliar. But I think everybody should know by now about that. So yeah, just one more housekeeping thing before we get started. We are going to have a live Q&A at the end of today's presentation. So at around 7:45, give or take a few minutes, we'll switch over to taking your questions, which you can submit using the Q&A tab, which is on the bottom of your Zoom toolbar. It's like the two little chat bubbles. And you can just click there, type in your question, and we'll hopefully get to as many of them as we can. I think our hard cutoff is going to be around 8 or 8:05. So we'll get to as many as we can before then, but be sure to submit those either while Bryant's talking or you can save them till that time. So yeah, let me just stop sharing my screen and I'm going to introduce our guest tonight, Bryant Riley. And Bryant is a finance professional with 4 and more years of experience in corporate finance and private equity real estate. He specializes in underwriting, acquisition opportunities, and portfolio asset management for multifamily, office, and retail properties. Bryant is also a program director at Minds Matter Philly, which is a college prep program for high achieving, low income students who attend local high schools in the Philadelphia area. Bryant holds a bachelor's degree in accounting from Roosevelt University, and he is from South Side Chicago. So welcome, Bryant, and it's great to have you.
Thank you, Derek. I appreciate the introduction. I'm really excited to be here, and I'm hoping that this session will provide a bunch of valuable information for folks who are attending. And I also just want to thank everyone for being here in terms of just, real estate is a continuing learning cycle, and it's always good to see people really taking the time to invest in their craft and get better and learning as much as possible in the real estate field. So thank you again for the introduction. And then at this point, I think I'm going to go ahead and share my screen and we can get this thing rolling.
Yeah, and while you get set up there, just give everybody a heads up. Tonight's going to be a little bit different. Rather than like an interview and a conversation, Bryant's going to share his screen and walk through, his presentation with you, as well as go into some Excel sheet proformas and everything. So you'll hear less of my voice, but that's all right because we have Bryant here to share his knowledge with us. So I'm going to hop off and Bryant, take it away.
Perfect. Thank you. Okay. Derek, can you confirm really quick that folks can see my screen?
Yep.
We're good to go.
I'm seeing Proforma Modeling 101.
Perfect. Okay. Thank you. All right. So as what Derek mentioned, the goal of tonight is really just to go over the foundations of building a proforma model. There are, in my experience, there are a bunch of different ways that people show proforma models, and it can be confusing depending on who is building the model. And my goal is to really demystify what a proforma model is and try to provide you all with a standard structure of looking at a proforma so that it doesn't matter what deal you're looking at, you'll have a good understanding of how to look at a proforma, no matter if you are looking at a proforma model and through JUMPstart or through an outside party such as a lender or an investor. So that is our overall goal. I just want to help everyone have a great foundation of a proforma model tonight. All right, so before we go into the proforma model, I just want to give a brief background about my experiences thus far. So I actually started my career at PepsiCo in Dallas, Texas as a financial analyst. I also worked at Shift Capital. I'm not sure if anyone in the room is familiar with Shift Capital, but it's a private equity, social impact real estate development firm located in Philadelphia, located within the Kensington neighborhood of Philadelphia. I was a senior financial analyst on the team, so that included underwriting, acquisition deals, and mostly asset management as well. So figuring out a way to optimize our P&Ls and figuring out when it was a good time to either sell or refinance our existing properties. Also, more recently, just to back up, also I ran the JUMPstart Kensington program at Shift Capital. So I'm not sure if anyone in the room is familiar with the JUMPstart Kensington program, but if you are, I would love to see your faces or pop in and just to leave a comment and say hey at the end of the presentation. But JUMPstart Kensington program is very similar to the JUMPstart Germantown program. We had our own funding. We had a cohort. We had a cohort every single semester, and I ran that for about a year and a half. Probably went through about 4 to 5 different cohorts. So that was a lot of fun. And so I know the JUMPstart program pretty intimately at this point. And then more recently, I'm actually joining a private equity real estate firm in Chicago called Green Corp Partners. Not to get confused with Green Book Capital, which is what you also see on the screen. But yeah, I'll be joining a private equity real estate firm in downtown Chicago called Green Corp Partners, primarily focusing on senior housing acquisition opportunities. And then also I'm the founder of my own real estate company. So with the goal of helping real estate developers really build models for their development opportunities. So for example, a developer will come to me and say, hey, Brian, I'm thinking about building a 24 unit ground up development project. Can you provide the pro forma so I can properly underwrite the deal and then shop that pro forma around to different developers or not developers, but lenders or equity investors. So that is a little bit more about my entire background. If you all have questions, we can save that for the end. Okay, so going into the meat of the presentation. So there are really 3 takeaways that I want folks to get out of this entire presentation. One, I'm hoping that you all would know how to deconstruct a pro forma. And basically what that means is know all the ins and out of how to build a pro forma model, right? So again, if you are looking at a pro forma from Jumpstart or through an outside party, you will have all the tools and wherewithal to know exactly the components that should go within the model. Okay, so that's one. The second thing is, once you are done building that model, how do you communicate that model to different lenders, right? So you have a pro forma, you eventually probably want to secure some sort of debt in order to get the project funded. So your lenders will look at the model completely differently than your equity investors. So we will focus on those lender investment metrics and also those equity investment metrics that those 2 parties would want to know in order to fund your deal. So that's the overall agenda. Okay, so now before we even jump into the actual model, I think it's important to really set the tone and really understand folks' background so I can know how detailed I should be in just explaining the model. So the first question that I have for folks, and hopefully you see it on the screen now, is just, I feel comfortable making a pro forma model. So on a scale from 1 to 5, 1 is like, I have no clue what a model is. 5 being, I feel as if I can build a model. I feel comfortable looking in Excel, pulling up an Excel spreadsheet and actually inputting all of the information I need to build a model. So we're going to take about 15 to 20 seconds to answer this question, and then we'll see the results.
Cool. Thanks, Brian. And looks like we have over 75% of people voting so far. So I'm just going to give it a few more seconds here. And I apologize, Brian. I think I might have said Jumpstart Tioga when I introduced you, but I meant Jumpstart Kensington.
Yes. All good.
All right. It looks like we have 80 people or 80% voted. So I'm going to end this and share the results.
Perfect.
You should be able to see it now on your screen.
Perfect. Okay. So we have, I have no clue what a model is. That's 34%. We have about 40% saying they're about a 2, 3%, about 23% said they're about average. And you have about 2 people who said that they feel kind of really comfortable building models. So this is great. So that helps me set the tone to really walk through the model and making sure folks truly understand all the concepts. Okay, next question. I feel comfortable presenting a model, a pro forma model to a potential lender or investor. So same rating. So 1, not comfortable at all. 5, being very comfortable and experienced.
Cool. So people are quick about it. Thank you everybody for being quick about answering that. And looks like we have just about everybody. So I'm going to end that and share the results, and you should see it now.
Perfect. Okay. So we have about 61% saying that they're not comfortable at all. 22% saying they're somewhat comfortable. 13% saying average, and about 4% of the folks said that they're somewhat confident. Okay, that is perfect. So this is actually great because I think I really tried to tailor this presentation and just to make sure that everyone can kind of start from the beginning. So I'm hoping that you all find a lot of value out of what I put together. Okay, so before we jump into the actual Excel spreadsheet and go into a pro forma, I think it's really important just to understand what is a pro forma. So a pro forma is a method of calculating financial results using certain projections or presumptions. And it's essentially, that is a fancy way of saying a pro forma is basically your best educated and informed guess of future revenue and expenses. So let that marinate, soak that in. A pro forma is basically your best and informed guess or estimates of future revenue and expenses on a project. So that's essentially what it is. It's all just plus and minuses. So just keep that in mind as we walk through the pro forma. All right. So I think I was thinking about putting together this presentation. I wanted to figure out a way to really drive it home. So I figured, why not do a sample case study analysis? So we are going to look at a buy and hold case study analysis, and then we're going to walk through a example pro forma. All right, so I'm going to read the prompt really quickly, and then we're going to go through the actual pro forma. So, okay, so Jessica is purchasing her first investment property in West Philly. She is under contract to purchase a 3-bedroom, 2.5-bath, single-family home for $110,000. The property is well maintained by the current owner and will require an additional $20K in renovation costs to complete a light rehab. Also, Jessica has secure financing through a local lender that is offering her a 3.5% interest rate, 70% loan to cost, and 30-year amortization. The loan fee is 2%. Jessica wants to sell the property after holding it for 10 years. The market rate rent for similar properties in the neighborhood is $1,500 a month. Okay, so I know that's a lot of information, and we're going to dissect that in the next couple of slides, but just keep this entire framework in mind. When you are a real estate investor, you need to be thinking about, where you're going to secure your capital from in terms of in terms of your lender. And so we'll go through all of those. What does it mean to have a 3.5% interest rate at 70% loan to value at 30-year amortization, right? Like we will walk through what that actually looks like. Okay. All right, so here is the sample pro forma that I put together last night. I know there's a lot of information, and again, our goal is to dissect this. So again, I want you all to focus on pro forma is simply revenue and expenses. At the heart of it, that's all it is. Addition and subtraction. And I think we all can relate to counting money and subtracting it. So keep that in mind. And as you go through a pro forma model, there are really a couple of different components you want to think about. So one is top line revenue, right? So this is pretty self-explanatory. So that is, the monthly rent that the property is gaining, right? So whatever the monthly rent is for a particular property, that factors into your revenue. That's the biggest line item. And then after your revenue, you have your operating expenses, right? So these are the monthly operating expenses that's required to actually keep your property running and keep it afloat, right? And then when you take your revenue minus your operating expenses, you then get down to your net operating income, all right, which is huge. So your net operating income is a concept that people talk about a lot, and it factors into your cap rate, and we'll discuss what that is later on down the line. But just know revenue minus operating expenses equals your net operating income. Okay, and then from there, from your net operating income, you then subtract out your capital expenses, right? So, and we'll go into details about what that entails. And sorry if this is a little bit blurry. Hopefully, we'll be able to see it much clearer in the actual Excel file.
And Brian, I just want to add that if anybody's having trouble seeing it, we'll be sure to send out the copy of the presentation afterwards, so you can take a closer look on your own computer.
Perfect. Thank you. Okay, so from net operating income, you then subtract out your capital expenses, and then you subtract out your loan payment information. So that is your monthly debt service that you have to provide to your lender. And then from there, you also have your unlevered cash flow and then your levered cash flow. And we'll talk about what the difference are between those two in a second. Okay, so now I'm going to go into the Excel model. Okay, and then Derek, can you confirm if you can see this, and let me know if I need to zoom in a little bit more?
Yeah, I think you could zoom in just a little bit, and yeah, that should be good. I'm seeing it clear.
Okay, perfect. Okay. So, all right. So here's a sample model that I put together last night, specifically for this case study. And we're just going to walk it down from top to bottom so that you all can understand all those components and those huge components that we just discussed in the last slide that I showed you. Okay, so the first line item you will see is your gross potential rental revenue. This is simply taking the monthly market rate rent timesing that by 12. So as you can see, Jessica said that she wants to hold the property for 10 years. And as you can see, you know, $1,500 times 12 equals $18,000 a year. She believes that the market rate rent based off her comps that she pulled in the neighborhood is $1,500 a month, right? So you take the $1,500 a month times 12 to get $18,000 in rental income for the year. So hopefully that first line is clear. The second thing you really want to focus on in terms of your revenue is physical vacancy. Many lenders will require a physical vacancy, and then most properties have a physical vacancy period, especially during turnover, right? So if you are moving out one tenant and you need to maybe clean up the unit and move in a new tenant, maybe that property will sit vacant for a month or so, right? So you need to factor in some sort of vacancy within your property. For this particular case study, I just said a 8% vacancy. And also, one thing I forgot to note, I want you all to focus more so on the concept versus the numbers, right? The numbers this is all made up, this is all fictitious, but the goal is to really focus on the concept and really understanding, okay, what is effective gross income? What is operating expenses? What is net operating income? So focus more on these different line items that you see me highlighting in column D, because that's important regardless of whatever deal you're analyzing. Okay, so in this particular proforma, the physical vacancy is 8% is 8%, and then so once you take your gross potential revenue minus your physical vacancy, you get your effective gross revenue. As you would notice, as you can see, the physical vacancy is higher in year one than it is in year two. And that is because during the beginning, when we looked at the case study, we said that there needs to be a light rehab completed. Well, if a light rehab needs to be completed, after Jessica closes on the property, she needs to allow some time to complete that light rehab. So over to the right, I have our rehab budget of $20,000. And then the rehab is going to take 3 months to complete, right? So during that time period, there will be an additional vacancy that you will have during your first year. So that is why the vacancy is higher in the first year than the second year and throughout year 10. All right, so going back to the basics, gross potential rental revenue minus physical vacancy equals your effective gross revenue. The other thing I'll add is that if you are a multifamily unit investor, let's say you're looking at, I don't know, fiveplex and up, there will be more line items that you need to consider a part of this effective gross revenue, such as credit loss. So that just basically means if your tenant is not, you need to factor in some sort of assumption just in case your tenants do not pay rent. And then I forget, rent concession. So in Chicago right now, because of COVID, I think I read somewhere that rents are down 7% year over year due to COVID, of course. And so a lot of apartment complexes are offering rent concessions. Basically, they'll give you 1 or 2 months of free rent in order to move in. Well, that's actually a real expense that is hitting your P&L, right? Your performance. So that's commonly seen in the bigger multifamily unit classes, but as of right now, if you're a single family home investor that's doing buy and hold, you primarily just want to probably just focus on your gross potential rental revenue and then your physical vacancy. All right. So from there, we get down to our total operating expenses. Your total operating expenses, as you can see over to my left-hand side in column T, I made a bunch of assumptions about the operating expenses. So $300 a month and property tax, $100 a month, and insurance, The management fee, property management fee is 6% of the effective gross income. Leasing and advertising fee, $40 a month. Repairs and maintenance, water expense. I assume that the tenant will pay the other electricity bills, or utility bills, and then the owner would be responsible for paying water, and then other miscellaneous expenses that I left zero. So again, I can easily change these numbers if I want to. Of course, in your case, you want to make sure that you're making informed and educated guesses, and we can talk about that more later in terms of how you actually come up with the real numbers for your deal. But again, I just want you all to focus on like more just so the concept. Okay, so from effective gross revenue minus your operating total operating expenses, you then get down to your net operating income. All right, so hopefully everyone's following me at this point. Okay, after your net operating income, you also refer to as NOI. After that, you have your capital expense reserves. So your capital expense reserves is, you may be wondering what's the difference between total capital expenses and your operating expenses. So your operating expenses are expenses that occur on a month-to-month basis, right? Your capital expenses are long-term expenses. So that is like, maybe Jessica needs to replace the roof every 5 years, right? That's not something that she needs to do every single year, but putting a new roof will also probably increase the value of the property. It's a long-term appreciation play of the entire asset. So think of your capital expenses as long-term expenses. They're usually one-off here and there, versus your operating expenses are month-to-month expenses, right? So you have to pay insurance every month. You have to pay you probably have to pay a management fee to whoever's managing your property every single month. There will be probably monthly repairs and maintenance expenses. You have to pay a water bill every single month. So that is the difference between your capital expenses and your operating expenses. All right. So the second thing you need to include in your total capital expenses is your rehab expenses. So as you can see, that is included in year one. So Jessica plans to, as soon as she purchases the property, go ahead and complete the light rehab. Okay, so the capital expenses and your construction expenses make up your total capital expenditures. And then from there, we jump into the next line item, which is your total loan payment. So this is just, in her case, in Jessica's case, she said that she was able to talk to a lender that's going to allow her to do a 70% loan to cost for her particular property. So what that looks like is that, we set the purchase price is $110,000. And the rehab cost is $20,000. So if you add that together, you get $130,000. And then 70% of $130,000 comes out to $97,000. So that is her actual loan amount, right? And then from there, we also know that it's a 3.5% interest rate and a 30-year amortization. In this second tab, I have an amortization schedule. You can always just find this online. It's pretty easy to find. But this will allow you to know exactly what the interest and principal payment is every single month, and then what your total payment is. So that, hopefully that's self-explanatory. I know most folks probably own a home or pretty familiar with how loan payments work. But so after that, you take your, so after you have your total capital expenses, you also have your total loan payment. So when you take the NOI minus total CapEx expenses minus total loan payment, you then get to your levered net cash flow. As you can see, we have this unlevered net cash flow. This basically means that let's say you wanted to purchase the property outright, right, with no debt, right? That's basically what that means. So unlevered means, hey, I'm purchasing this property outright with no debt. Levered mean I am purchasing this property with some debt. So if you was to purchase it outright, it will cost you $132,000 versus if you buy it with a loan, with that $97,000 loan, it will cost you about $142,000. And I'll explain what those other line items that it's hitting, that's factoring into this total 142,000. So after we get to our cash flow after debt, which is the NOI minus CapEx minus total loan payments, the next thing you would have is your acquisition price. This is essentially how much you're paying for the property. And then you have your closing costs. I factored in the 5% closing costs at the top. You will see this at the top. So it's just 5% of the purchase price of the home, right? So we have that. And then the next thing you want to factor in is how much you think you can sell the property for. So this is probably one of the most, not complicated concepts, but just try to pay special attention to what I'm about to say about the sale price. So usually in commercial real estate, or just in real estate in general, your sale price is determined by your next buyer's net operating income, right? So the way that this works is that you would take your net operating income from the next buyer, so whatever that next buyer is. So that's in year 11. So I already factored in the year 11 NOI. And then you will divide that by a cap rate, an exit cap rate. So your exit cap rate is, if you are curious to know how you determine that, that is something that you can usually determine by talking to brokers, just your own individual knowledge of how much single family homes are trading for within your local market. Certain real estate agents who are familiar with investing will probably know what the exit cap rate is. So don't feel as if this is something you need to determine on your own. You just lean on your resources to figure out like what the exit cap rate is. And just to go over what a cap rate is simply your annual net operating income divided by your purchase price. So at the beginning, so let me back up again. So you have a going in cap rate and you have an exit cap rate. For me, like I said, the cap rate is the NOI divided by your purchase price. For me personally, I like to include the rehab budget in my cap rate as well. So our going in cap rate is 5.881%, and that is simply taking the purchase price it's taking the stabilized NOI at year 2, and then is dividing that by the purchase price plus the rehab cost, right? So our going in cap rate is 5.81. Jessica believes in 10 years, the cap rate will eventually decrease, and she can sell it at a 5.5% cap rate. So hopefully that makes sense, and I can clear up some things. The lower the cap rate, the higher the value of the property. So try to keep that concept in mind. When I first started in real estate, it was super complicated to know like how the cap rate worked, and we can go into more details about that. But always think of it as the lower the cap rate, the higher the value of the property is. Okay. So going back to our sale price. So again, in order to determine the sale price, we're taking the next buyer's NOI. So that's year 11 after we do not have the property anymore. And then you divide that by your exit cap rate to determine your sale price, right? So we're completely buying the property for, I believe, 130,000 plus, and then in 10 years, Jessica believes she can sell it at close to 180K. And then there's also just a cost of sale. You have to factor in the cost of just selling your property in terms of all of the closing costs that you have to pay that involves the entire transaction. All right. And then so that determines our unlevered cash flow. So again, that is just looking at the property, assuming you would buy it without any debt. But of course, most real estate investors do buy property with debt. So if you are buying the property with debt and you're getting a $97,000 loan, this levered net cash flow factors in you buying that property with debt. So as you can see, for your cash flows through years 2 through 10 are much higher versus your levered cash flow. And that is because your levered cash flow, you have to pay your monthly debt service, right? So the unlevered, you don't have to pay any debt because you bought the property outright. Versus your levered net cash flow, you have to pay your lender every single month. So your cash flow will be lower, but your return will be higher. For the most part, your return will be higher just because you're putting in less money in the deal, and still getting a great return. All right. So that is the pro forma. So I'm going to move over to the right-hand side, and that there's just one more concept that I want to walk through really quickly. Um, and I guess this is mostly found in commercial real estate, but there's a concept called sources and uses. Sources meaning where are you sourcing your capital from, right? So in Jessica's case, she is sourcing her capital from herself, so she's putting in her own equity, and then she's also getting a loan from the bank, that $97,000 that we talked about. Your uses is what are you actually using that capital for? So she's using that capital to purchase the property at 110,000, and then she's also using it to do renovations at $20,000. And then you have closing costs, the loan fee, and operating shortfall, which basically means, if there's any, this is just basically sometimes referred to as working capital, which basically means, hey, if is there any additional outside money that she will need to put up front just in case during the construction period. So this is maybe she needs to pay a contractor. You just want to always have some additional cash on hand to pay different folks that may not be covered by your loan. So this is additional out of pocket costs that she needs to have on hand. Okay, so your sources and uses should always tie. So as you can see, in this case, your total sources is 139,000, and then your total uses is 139,000. These two numbers should always tie. So you should always know exactly where you're getting your capital from, and then what exactly you're using that capital for. Okay, so I know that was a lot, and again, we will definitely open it up and let folks ask questions. But there's one more component that I want to talk about before we open it up for questions. So again, that's basically the pro forma model. But the second thing you want to really understand after learning all the ins and outs of a pro forma is really understand what your lenders are looking for and what your equity investors are looking for. So if you were to take this pro forma that I built and give it over to a lender, there are four major metrics that your lender is going to want to look into. One is your loan to value. Secondly, loan to cost. Thirdly is your debt service coverage ratio, and fourth is debt yield. So your loan to value ratio is simply the loan amount divided by the property value. And that property value is really determined at that going in cap rate that we discussed. So, once the property is stabilized, you have tenants in there, and you come up with your net operating income, and then you divide that by let's say your exit cap rate. That will determine the property value. I'll jump back into the model so you can see exactly what I'm talking about. And the second thing is your loan to cost ratio. So that is simply looking at your loan amount divided by the total project cost. So that total project cost will include acquisition costs, loan fees, closing costs, and renovation costs. The third thing is that debt service coverage ratio, and that is simply taking your net operating income and dividing that by the annual debt service, and this basically measures how many times over the property's net operating income can cover the annual debt service payments. And then the last concept that I guess most folks probably don't talk about, but lenders definitely look at this metric as well. And this is your debt yield, which is basically taking your net operating income and dividing that by your total loan amount. Basically measures your annual NOI yield as a percentage of the loan amount. So in a less simple in more simple terms, is basically used by lenders to measure their return on investment in the event of a foreclosure, right? So let's say you foreclose on a property and the lender needs to take that property back over. They want to know the net operating income that property is producing, and they want to divide that by the loan amount to know exactly what their return on investment is. So it's a metric primarily used by lenders, and they may not be as in most loans I've worked on, they have not like had a certain debt yield that they told the actual developer about, but I'm sure internally they have their own debt yield requirement that they like to stick to. All right, so jumping back into the model. So we're going to discuss all 4 of these metrics that we just discussed. All right, so the first thing we are going to touch on is the debt service coverage ratio. And this should actually be expressed as a positive number, not a negative. So I'm going to change that really quick. All right, so going back into the debt service coverage ratio. So again, your debt service coverage ratio is literally taking the net operating income and dividing that by the total loan payments. Most lenders require at least a 1.20 debt service coverage ratio. If you're analyzing a deal and it doesn't meet that 1.2 threshold, then you either need to figure out, okay, maybe I can decrease the debt that I am seeking so that the deal is approved by a particular lender. So you may have to inject more equity into the deal if it doesn't meet a certain debt service coverage ratio requirement. And then here's your debt yield. So your debt yield is taking your NOI, as I mentioned, your NOI divided by your loan amount. Again, that is your lender's return on investment, just in case you default on the loan. So that explains 2 metrics. And then your loan to cost, as mentioned, when we first started this case study, this particular lender is requiring a 70% loan to cost. And then there's one more. Where is it? Loan to cost, loan to value. All right. And then down here, we have our loan to value, which is basically, in this case, like I said, is taking that stabilized NOI. Year 1 is not stabilized because during the first 3 months, we have to rehab the property. So so the vacancy is higher, right? So we want to take the stabilized NOI, net operating income, and then you will have to divide that by the exit cap rate that determines the property value. So NOI divided by the exit cap rate determines the property. And then you are taking your total loan amount divided by that property value to determine your loan to value. So in my experience, most lenders will say, not most lenders, but just to give an example of a loan to value and loan to cost requirement, I remember working with a lender that said, hey, we will fund your project 100% loan to cost as long as it meets a 65% loan to value. So some lenders will have a threshold for both when you're looking at deals. Okay, so there's one more component I want to walk us through, and I'm going to try to speed up because I know we're coming in on time. The second thing I want to talk about is your equity investment metric. So this is the part of the pro forma that you should think about when you are thinking about taking on investors. They will primarily focus on 4 things as well. The first one is that capitalization rate. The second one is the internal rate of return, often called your IRR. The third one is cash on cash return. And the last one is equity multiple. So your capitalization rate is your net operating income divided by your purchase price. The going in cap rate is during the acquisition period, and then the exit cap rate is during sale. So I think we already covered that, and we can talk about that more later. Okay, your internal rate of return is an annualized time-weighted return on equity invested, and basically that factors in a time value of money. IRR can be kind of complicated to understand, but think of your IRR as, if you have an investor that wants to buy, that's the debating between investing money into the stock market or into real estate. They would think of they will consider the IRR of a real estate asset. So they want to know what will be their rate of return if they invest in the stock market versus versus a real estate project. And if your real estate is more attractive than investing in the stock market, and maybe it has the same amount of risk as investing in the stock market, usually it doesn't, but let's just say hypothetically it does, they will most likely want to go with your particular project. Okay. The next one is the cash on cash return. So your cash on cash return is your annual net cash flow divided by your total equity invested. So that basically just means, okay, I'm putting X amount of dollars into this project and I'm getting X amount of dollars in return on an annual basis. So that is expressed as a percentage. So that's important to know. And then the last component that investors want to see in real estate deals is the equity multiple. This basically means the total cash distributions divided by the total equity invested. So another way to think of it is just the total cash inflows divided by your total cash outflows. And again, I know this is high level. I'm going through this pretty fast. But so we're going to jump back into the model so we can look at exactly what these numbers mean, and then we'll open it up for questions. All right, going back into the model. So your cash on, so I have a bunch of different equity metrics at the bottom for this particular project. So the first one we see is our average cash on cash return. So again, I want to unhighlight this really quick. This formula probably looks more complicated than it really is, but essentially it is taking the total amount of cash that you are investing, and then it's taking the actual cash flow that you're getting divided by the total amount of money that you have invested in your deal. So your levered cash on cash for year one is 2.59%. In my experience, most cash on cash returns needs to be at least in 8% annualized. Most investors want to see at least 8%, but again, that's going to depend on what type of investor you're looking for. Maybe they are only focused on stabilized assets, and stabilized assets traditionally have lower returns versus properties that have, huge construction costs that needs to be invested into a property. So hopefully that makes sense. It's simply just taking your total cash flow for a particular year and dividing that by the total amount of money you have to invest in the property. So that is carried through all the way to year 10. And then the next one, again, we're going to talk about the equity multiple, and that is simply taking the amount of money that you are, it's actually taking the total amount of cash flows that you will receive and dividing that by the amount of money that you have invested in the property. So basically, this property is getting investors a 2.65% equity multiple, which basically means they're getting their equity back more than 2 times. Okay, and then the last concept, I think it was cap rate. We already kind of discussed the cap rate. So I don't want to drain that, but again, it's just the NOI, the net operating income divided by a cap rate to get the net operating income divided by the cap rate gives you your property value. Your cap rate is your NOI divided by your property value gives you your cap rate. So that would be net operating income. The property value is, we already determined that it's just the NOI divided by this 5.5%. And then, where is it at? 5.5. The NOI divided by, where'd it go? Okay, yeah, it's just the total amount of money invested in the property. So the purchase price, the rehab budget, and divided by NOI gives you your cap rate. Okay, I think that hits all the metrics: capital, capex, internal rate of return, cash on cash return, and equity multiple. Okay, So hopefully this is as clear. I know it's some of this takes retention, and when I first started off in real estate, this took some time to really grasp and understand, but it took repetition of really going through deals to really understand all the levers. Okay, so next up, these are additional resources that folks can use if you're interested in learning more about how to build Proforma models. My favorite is Break Into CRE. They literally have, it's not free, I believe it's about $40 to $50 a month, but they really have detailed models and you learn how to build them from scratch. So I've taken those courses and they have been really good for throughout my career thus far. Another one is Adventures in Commercial Real Estate. It's very similar to Break Into CRE. Basically, you can sign up and take a bunch of Proforma modeling courses. And then YouTube is always free. So you can easily type in real estate Proforma model and you can pull up free models via YouTube. And then the last thing is, I think that's it. So yeah, if you want to connect with me outside of Jumpstart, you can find me on LinkedIn, and I also build, like I mentioned earlier during this presentation, I build real estate Proforma models for developers, primarily in commercial real estate. I think the small work on was 24 units. But if you have any questions or if you're interested in services, feel free to email me at bryant@greenbookcapital.us. And that is it. So at this time, we can open it up for questions.
Great. Awesome, Bryant. Bryant, thank you so much. That was a great, overview of the entire Proforma. And I can tell you're a finance professional because you walked through that like a breeze. And before we get into questions from attendees, I just want to ask you, I know you have a certain perspective as a finance, your day-to-day life consists of finance, but for somebody who, maybe the only perspective they have from finance is a high school or college course that they took, what tips do you have for some people to start to understand all those formulas and start to kind of get more comfortable with the Proforma? Because, obviously, if you're like us and you work in the industry, you kind of pick up on things day to day. But for somebody who has a full job that's unrelated to finance, it could seem like a totally different language. And obviously, sessions like this are a good place to start. And thank you so much for offering it up. But what tips do you have for people, I guess for their self-confidence, as they start to get into it? What can they do to
I think repetition, when I first started off in the industry, one, I had a finance background, but I knew nothing about real estate finance at all. Like when I started my job at Shift Capital, again, which is a private equity real estate firm, I didn't know what a cap rate was. So for me, it was, taking classes outside of work to really understand all the concepts. But I think if I could point to just a couple of things that I think people should really focus on and really try to understand if they are serious about, let's say, they eventually do. I know most people aspire to be huge real estate developers or want to do bigger projects. And that first concept you really have to understand is that a cap rate. Again, it can be super confusing sometimes because it's like, okay, as the cap rate, which is expressed as a percentage, as that decrease, then that increase the property, that increases that means that the property value is higher. Like in my mind, like that, when I first heard that concept, I was so confused and I was like, that doesn't make sense to me. But I would say that's definitely something that people need to familiarize themselves with, is definitely the cap rate. That's one of the first concepts I think most folks need to learn. And then talk to lenders, right? Talk to lenders. Talk to people who are invested in deals on the equity side. Lenders are super helpful. They are usually not intimidating until it's time to present a deal. But you can easily call a lender and say, hey, I'm interested in sourcing different lenders, and I have projects that I may have in the pipeline. Can you give me a term sheet, is what they call it, or give me a basic rundown of how you all fund deals and what are your debt investment metrics requirements to get these deals funded. So I would say just start there, just really off the bat, know what a cap rate is, talk to equity investors, talk to debt lenders to get a grasp on these concepts.
Awesome. Yeah, I think that's great advice. And hopefully as we go through some of these questions, we'll be able to provide some more information. So I'm just going to start going through them, and we'll go for around 10 minutes because it's getting kind of late here. But I will be sure to include Brian's email in the I'm going to send out the PowerPoint as well as if it's all right with you, Brian, I can attach that template that you had.
Yeah,
I'll attach that along with Brian's contact information so you can continue the discussion and get some more specific insight if you need it. But yeah, we'll start with the Q&A here, and thanks to everybody for submitting questions. And I'm sorry if we can't get to them all just because time constraints. But the first one here comes from Uzoma, and they're wondering, I'm used to using hard money loans to finance my buy and hold projects. Was the sample loan that you shared a 203K loan or some other type of product?
It was fictitious. It was made up. It was purely for illustrating a loan. Like I didn't contact any lenders. It was just purely to just show folks a simple, easy walkthrough of how a loan factors into a pro forma. So yeah. I'm gonna leave it at that. I know hard money lenders typically have higher interest rates.
Mm-hmm.
They probably have shorter, they don't amortize over 30 years. They want their money much sooner. But yeah, good question.
Okay. Next one comes from Samantia. She's wondering, is there a program or software that you would recommend that we can use that would automatically produce the needed information for the pro forma that would qualify with lenders? A software that is dummy proof, she says.
Actually, I don't know. The Jumpstart Proforma is really good. And I know that specifically for that particular loan program, but I don't think you can find your own Proforma template out there, but at the end of the day, you are still going to have to input your own numbers, right? Every single deal is going to be different. So there's always going to be some sort of numbers that you have to put in, or you can hire someone like me to have. And I'm not the only person that does this type of work. You can also use services like Upwork. I think Upwork.com. They have a bunch of real estate professionals on there. Bullpen.com is another website if you're curious about someone building a pro forma for you. And I'm sure they'll spend more time and walk you through it if you really want to understand it. But you cannot get around from not inputting your own numbers in Excel file.
Okay, great. Next question comes from Josh, and he's wondering, if you know the net operating income, can you walk through how you would use that to determine what to offer for a property?
Yes, I love that question. So if you have the net operating income, and then your goal is to find out what other one, you want to know what sort of like return you want on your property. So I guess the other thing that I didn't talk about is that the lower the cap rate, the more stabilized the asset is. So for example, if you're purchasing a property in, I don't know, let's say Rittenhouse Square, maybe those cap rates will probably be between not three, that's New York cap rates, but let's say Rittenhouse Square will probably for a stabilized asset that's already cash flowing, probably between, let's say, 5 to 7%. But the more you go out into the outskirts of like downtown and more into distressed neighborhoods in Philadelphia, you expect a higher return on your investment because you're investing in more risky areas, right? So you would expect your cap rate to be higher. So purchasing an asset in Rittenhouse and purchasing that same exact asset in, let's say, Kensington, which is the neighborhood I worked in, the cap rate spread, the cap rate may be 5% in Rittenhouse, but it may be 11 to 12% that you expect in Kensington. So I say all that to say that the more risky the investment, the higher your cap rate should be. And then secondly, to determine that value, you want to look at comps. So if you can talk to different brokers or real estate agents and say, hey, I know that the NOI for this property is, I don't know, $10,000 a year. I just need to pull similar cap rates for similar asset classes for similar properties. And let's say that's, I don't know, 10%, then you'll divide that NOI by that 10% cap rate to determine your purchase price.
Great. Next question here comes from Majora, and she's wondering, where was her total 42,000 debt reflected in the pro forma? So I think she's just wondering where I'm not sure if that was a number you gave or that was on the Excel, but and
Oh,
it's
the
okay.
equity. I think 42 was the equity.
Okay.
Okay, wait. Can you read the question one more time? I just want to make sure I'm getting I'm answering correctly.
Wondering where was her 42K debt reflected in the pro forma?
Oh yeah. Should I share my screen really quick again?
Yeah, sure.
So I think they're referring to the equity here.
Mm-hmm.
So again, it was a 70% loan to cost, right? So and the total development cost, the total cost to purchase this property is 139,000. So this 42,000 is literally just the difference between the 139K minus your $97,000 loan equals your equity at $42,000.
Mm-hmm.
So hopefully that makes sense.
And while you have that up, Keith is asking another question. In your example, capital expenses was what percent or what number? So maybe you could just go over where that was.
Capital expenses is only $100. Again, don't focus on the numbers, focus on more so on the concept. I can easily change this to 200, 300, any number that you all see fit. Like that cap rate number, that capital expense number will be determined depending on how big the property is. It will be determined how old the property is, like what sort of expenses you think will come up over the next couple of years. So that will be determined through your due diligence when you're walking through your particular asset.
Gotcha. And probably my second to last question here comes from Mark, and he's wondering how widely do these assumptions vary? And if you can't narrow a number down or the numbers fluctuate widely, how do you write that into your pro forma? So maybe just what's the margin of error on these numbers, and how do you pick one?
What numbers are we talking about? Cap rates? Are we talking about operating expenses?
Let's go with your operating expenses and the ones that are kind of up to your discretion, I'd say.
Yeah. So all of your operating, again, a pro forma is taking your best guess and best informed guess of future operating revenue and expenses. That should be determined by historical data, right? So that should be determined by maybe when I worked at Shift Capital, we leverage other assets that we already had historicals for to inform future projects, right? So if we had a multifamily unit that we already developed and we already know the operating expenses, we can pull the historical 12-month rent roll and operating expenses. We will use that to inform our next project. So all of these operating expenses should be informed by your historical expenses. And this is especially for the homeowners, like you probably know how much your insurance costs for a single family home. Like that shouldn't be hard to determine. You can call different property management companies and ask them how much they charge to rent out a particular space. Water expense, we all have water bills, right? So we can probably determine what a water expense is on a single family asset. Repairs and maintenance will vary. You probably need your property managers are probably really great resources for determining your repairs and maintenance. If they're managing the property, they have access to historical data to say, hey, I have a similar asset class a similar property that I'm already managing. And this was the amount of expenses that property incurred on a monthly basis. So all of your operating expenses need to be informed by historical data, whether that be through a property manager, your own project, investors that you already know in the industry. And then the second thing I'll add is that sometimes lenders have a particular requirement that they will set as the standard. So one lender may say, hey, we know this market really well. 8% vacancy is our minimum threshold that we like to see on our projects in order to get your deal funded. So that's something to always consider. Maybe what you are estimating may be different than what your lender may say is a hard requirement that they like to see in their projects.
Right. Okay, great. And the last question I have for you here, I think we know the answer to, but I'm going to ask it anyway. And Bruce is wondering, should you do a pro forma for a single family property? And I think he's just wondering, just in general, maybe
this is a pro forma for a single family property.
Right. Yeah, but maybe in general, it's just maybe the question could be what types of properties need a pro forma? Are there any projects that don't?
I would say, honestly, I feel like a lot of single family homes probably don't need a pro forma. It depends on the investor though. Like I'm curious to know, I would ask the person who did the hard money loan. I'm curious to know if her hard money folks required her to have a pro forma put together. But I think it varies. We know for the Jumpstart program it does, right? And you walking
Yeah,
by single family homes. So I would say in general, yes, folks need to see black and white numbers in order to fund a deal. But if you're buying, let's say you are an investor, but you're doing like an FHA loan, no, they're not going to require a pro forma. But you probably want to have one in the back end so you can know exactly your operating expenses and revenue for that particular property and have an exit strategy before purchasing it. So it's always good to have one, even if the lender doesn't require it.
Great. Awesome. And just for sake of time, I think we're going to wrap things up here. And thank you to everybody who had submitted questions. I'm sorry if we couldn't get to them all. But like I said, we'll be sending out the Excel sheet that Bryant was sharing, as well as his presentation in an email to everybody who registered for today. So look out for that. And hopefully that can answer any outstanding questions you might have. But yeah, before I close out here, Bryant, I just want to thank you again for taking the time to come and talk tonight. This was super valuable, and I spend a lot of my time looking at pro formas, that are submitted with loan applications. So it was particularly helpful for me to kind of get the like a finance professional's view of it, and hopefully it was helpful for everybody else to kind of just start to learn. It's a lot of information, and I think the only way you can start is just by like exposing yourself to it and taking chances on things. So thank you for doing that for us.
Yeah, I mean, the last thing I'll add is just like repetition breeds like I guess excellence. So just keep that in mind. Like I said, it took me a while to really understand all the different concepts. But the more you look at it, please take some time to review the deck and like review the Excel file and just get familiar with the concepts. And I guarantee you, if you just keep at it, it'll start to all make sense. So don't feel as if you just walked away knowing just a little bit about a cap rate tonight, I'm satisfied, because that is one a hard concept within itself. So just keep in mind, be gentle with yourself in this process, because it's a lot to soak in. And I just want to say also, just thank you all for having me tonight.
Great. Thanks so much, Bryant. And just a heads up of what we have coming up next week on April 12th, we have Jacob Fisher, who's going to be talking about low-income housing credits. And the week after that, on the 19th, we have Tariq Brooks, who will be speaking about the basics of corporate formation and getting your entity set up before you start investing. And you can go to jumpstartgermantown.com/events and find all the registration links for those, as well as just a brief bio about what the session will hold. You can find all past episodes of the JUMPinars on the Spotify and Apple Music, anywhere you can find podcasts. If you just search Jumpstart Philly Radio, it should pop right up. I don't think we're going to have this as a podcast just because there's a lot of visual, guides that might help out with it. But Bryant, I would love to have you back, and maybe we could just talk a little bit more abstractly and less with numbers. And I think people would love to hear you speak more. So hopefully we can look out for that. And if you want to view the recording of this session, that'll be available at jumpstartgermantown.com/jumpinars, and you can watch the full video, just like you saw it tonight, with the question and answers included. And that's all I got. So I hope everybody had a good time, and thanks so much again, Brian. And I hope everybody has a good rest of your Monday nights. All right. See you later, everybody.